Welcome, welcome, everyone. Happy Monday. I know you guys are enjoying my nice little music selection there. Yes, yes. So, welcome to the American Dreamers Club monthly financial webinar. I am your host tonight. Not like you guys don't know me, but you guys know who I am. Nakai Lewis, president and founder at American Dreamers, and also licensed agent for 12 states. And I've been in the business for over 2 years, and I've coached over 500 entrepreneurs in the past 10 years. So tonight's webinar is a financial webinar, and it's pretty much all about, you guys learning a little bit more about the IULs, So first and foremost, if you guys want, you can put in the chat, what city, because I know a lot of most everyone on here is from Jersey. Hi to some of my clients, friends, family. Thanks again for joining on this webinar tonight. Passaic, all right. So we got Passaic, New Jersey. Welcome, welcome, Madeline. All right, Long Island. All right, Rashawn, Long Island's here. Great. All right. So we have a little bit of everyone from Jersey, right? And I know a few others in a couple of their hometowns, Patterson, Jersey City. Kyle, I know Jersey City's in the building. Hackensack. Yes, yes, love it, love it. So Jersey's here. We representing. And okay, Orange. All right, Orange representing. Awesome, awesome. So basically for tonight, my whole goal was to educate you guys when it comes to not only your finances in the IULs, but just learning the myths and the basics. Because a lot of times we're on social media, we're hearing all of this about IULs, right? But the thing about it is they're not licensed. A lot of these people who talk about this product and what it can do, they're not licensed agents. They don't work in the business, and they couldn't even write a policy for you, even if they wanted to. So one of my biggest thing is like for the financial club. If you guys are not part of the WhatsApp group, remember, after this, I'll definitely send you a link to the WhatsApp group. You can reach out to me. The goal of the financial club is we're going to be having monthly webinars so we could educate and build our mindset when it comes to finance and how we can actually elevate ourselves, learn about different areas of finance, how it works at the same time, and like how it applies to your life, right? So I appreciate, your time today on this webinar. So a little bit on the index universal life, like what exactly is index universal life, right? I'm going to break down a lot of that for you tonight. So have your pen and paper. I'll take questions after. We'll have the Q&A. So a lot of times, IUL is always pitched as, the cash value type of insurance, where you can pretty much benefit from the market gains, which is all tax-free, right? Without the risk of loss during the market downturn. Right? So basically, when you purchase your IUL insurance policy, you're getting that permanent coverage as long as your premiums are paid. And your policy also includes a death benefit, which is paid out to your named beneficiaries. And the policy, it can increase or decrease in value during the lifetime through the cash value component. I'm going to go over a couple examples of that tonight so you could actually see it with your own eyes, exactly like what does it look like, right? And basically, so the portion of the cash value of it earns interest based on the performance of the underlying stock, right? And sometimes those indexes are tied to certain indexes, like on the S&P 500, right? So we'll talk a little bit about how that works when the index is kind of moving up and down, and then how does that really affect the rate of the policy. So when it comes to some of the benefits of the index universal life, right? It's all about high return potential. So of course, every year when if for some of you guys have index policies that are on this call, some of you guys don't. So for those individuals who already have index policies, what we do is like an annual kind of review. Right. So with the newer ones, we want to wait at least 2 years to see what it does with that particular company and index. If it's working and it's giving, the numbers that we see on the illustration, and I'll show you a little bit what that is, you'll understand, okay, then this is a policy or with the company you want to keep it with because it's getting those returns. If you don't see those returns on your policy, then this is when you might want to take a little bit of action. Say, you know what, I think this is something that I definitely want to change. And that's usually me as the agent. I'll always help you in that space, right? Also, you get greater flexibility, right? So what does that mean exactly? So for example, on a lot of these policies, not only are you going to build cash value, right? And then not only it's going to protect you in case if something happens that's going to go to your beneficiaries, but you could add something what we call a rider. So what is a rider? So a rider is this. Sometimes you can get long-term care rider, you can get a critical, chronic, or terminal illness rider. So God forbid you get, diagnosed with any of those things during your lifetime, you could tap into the cash of that policy to pay not only your rent, your private bills, whatever you need once you've been diagnosed, because a check literally gets cut to you, which is amazing. And a lot of people don't know that. And they always think, well, oh no, insurance is for when I die. No, insurance is also a way that you can also build over time, right? Your little nest egg so you can retire. And at the same time, you have an opportunity to something, we never know. We got COVID rampant. There's so many things going on. So you have an opportunity to also tap into that. The third thing is the tax-free capital gains. Now, a lot of you guys here are in real estate, right? You guys understand a little bit how capital gains works when you're buying and selling properties, and then, or if you're an agent and you actually have, some funds after getting or selling a property, and you have leftover funds, how that works. So good, little strategy. And again, this is for the financial club members and what we do, because it's all about strategy when it comes to your policies, right? On the capital gains, right? You do not pay capital gains because basically the cash value is going to grow over time unless you stop paying your policy, then, and you abandon it before it actually matures. So the great thing is that capital gains do not apply to insurance policies. That's a little tip for you guys. You want to write that one down, okay? And, basically you can also take tax-free loans, right, from yourself. So you can literally borrow against yourself without triggering taxes or penalties or things like if you have a 401k and, you're basically taking like an early withdrawal or 401 from your 401k there. Another thing is the no Social Security impact. So a lot of us are young, right? We're in our 30s, some of us are in our 20s, right? And, basically what that means is later on when you're trying to retire, all the income, whatever that you're getting in, it's also going to configure into how much Social Security is going to cut you a check, right? So the great thing is if you're saving a ton of money here over your lifetime, you're putting it into these types of policies, right? By the time Social Security time runs around later on, I know we're not thinking about like, man, I'm young, I'm not thinking about that, but we have to start thinking about these things, right? You literally can tap into that, and the Social Security of whatever that you're tapping into for your policy is actually not going to count towards your Social Security benefit. So you could still get that same check from the government, right? You could still have your 401k, you could still have your nest egg, and you got an IUL. All right. And then lastly, on the death benefit side, so basically this money again can be passed on as a tax-free benefit to your children, your family members. It can go to a charity. It can go to your favorite business. Like it doesn't have to necessarily be a person. You may have a cause in mind that you really like and you want to be remembered. You can usually, use that for that as well. So that's also something to note. All right. So a couple of the drawbacks, right? Because, I'm talking all the positives, but I'm also going to be honest, right? So there are a couple drawbacks when it comes, to the index universal life, which we call IULs, right? Because index is tied to an index, right? So it's the possible limits on returns. So let's say, for example, the policy has what we call, you'll look on and you'll see a 70% partition rate. If the index, which, that's like S&P 500 or any of those types of indexes, right? And if the index only grows by 10% and your cash value would be like about 7%, so that's 10% times 70%, right? Some policies give you 100% of that. And I know we're like, okay, we got a lot of percents going on right here, right? but literally your maximum return will only be 10%, but it really depends how the policy performs that year. So, and then there's also the cost of basically for the insurance, right? But I'll talk more a little bit about that. So it just depends on the participation rate of the index that it's tied to. So it's also good to consider like, hey, are you really trying to look for something with high cash values? There's actually indexes that are uncapped and they have strategies up to 100, 200%, right? And then you could really see some really big cash values being packed in there, depending if that's something that you're looking for. Another thing is what we call the unpredictable returns, right? So on the unpredictable returns, you get your guaranteed interest rate, right? And this means basically if you're comfortable writing out fluctuations, one year you might have zero credited, the other year you may have 15,000 credited, right? And it just basically, it kind of fluctuates. So just understanding that every year is not going to be the same. And I'll also show you over 20 years what the percentage has been. So you could kind of, have a better understanding exactly what that means for you. And then lastly, the fees. Now, these how these insurance companies make money. Now, you guys are like, okay, so they're taking our premium. What are they doing with it, Nakai, right? Tell us the scoop. Okay, so when it comes to the fees, right, we have the premium expense charges. So you put in your premium, so you're paying like $100, $200, $300, whatever. Then you have the administrative expenses, depending, that can fluctuate anywhere per policy. The riders have a cost. Then there's the fees and commissions of the policy, and then the surrender charge. So these are all charges that can be sometimes fluctuating depending. And if you're going to take a loan, sometimes it's like $100 charge to take the loan from yourself, depending on how much cash is actually in the policy. So all of these fees actually detract from the rate of the return that's actually offered in the policy. So understanding that, yes, there's some upside, there is some downside, and then kind of weighing like where are you at in the middle, and then seeing, what's pretty much best for you, right? And basically, when it comes also to the index life insurance, is it really better than a 401k? Like, I get this question a lot, is it truly better than the 401k plans, and how that compares, right? So a lot of the plans, again, they each have their own advantage. It really depends on the person and what their priorities are. So basically, your IUL comes with the death benefit and the cash value, and basically the policy owner can borrow against it. And however, it just, again, depends on the premiums, the fees, but, on the 401k side, you have a certain time when you could take it out. Like, it's got to be, the 59 and a half age, and you got to wait for it to mature and that kind of thing, right? So just make sure that you understand that when it comes to comparing the IULs with the 401ks. All right, so we're gonna do a live demo. I'm going to stop sharing my screen and I'm going to pull up something here for me. 1 second. And this is telling me I gotta, I can't minimize my Zoom. Where can I minimize? 1 second. Let me do 2 parts here. Stop sharing. Let's see,